There are huge changes coming to the tax brackets for 2023, which means you and I are going to save money on taxes. And that's because the tax brackets have been moved up to higher income levels based on how much inflation has been skyrocketing lately. So what that means for you and me is that as long as our income hasn't kept up with inflation, the majority of us are going to pay less in taxes. Now, the exception to that rule is those of you who are fortunate enough and hardworking enough to get fat raises that keep up with or beat inflation. So that means that if you got a 7% or larger raise lately, congratulations, you're making more money. There's a chance you're going to keep up with those tax brackets and you're not going to see any benefits. But for the rest of us, we will. What you're going to get right now is three things. Number one, you'll get an explanation of the new changes to the tax brackets so that you understand them. Number two, you'll understand what it means for you and me in terms of how much money we're actually going to pay in taxes. And number three, you'll get an explanation of how tax brackets work because most of us still think that they work like elevators. Speaking of that, let's find an elevator right now to clear this up. Let's go. Many people think that tax brackets are like an elevator because when you go up to a higher floor, 100% of you is there now. You've hit the button, you've moved up, now all of you is up there and nothing is left down below. People think tax brackets work the same way. Each floor is like a new tax bracket and you represent your income. So your lower tax brackets are down here, your higher tax brackets are up there, and if my income goes up and crosses over the line to the next tax bracket or the next level, I'm taxed at that higher level, all of me. And so then that sucks because a large chunk of my money is taken away for taxes and I never get to have it to do cool stuff with. This is a huge problem because it's not how tax brackets work. With that logic, I've personally heard people claiming that they don't want a raise. Like they will resist a raise, they will turn down their boss because they're afraid it will push them into that dreaded next tax bracket. And in the end, that would pencil out to mean that the actual amount of take-home money they got was less. Like having a raise would cost them money. They do that math, they figured that out, and they figure that we should deny the raise unless it's a massive one. This is not how tax brackets work. Instead, tax brackets are a lot more like a bucket. The water going into the bucket is like the money that you make. The more money you make, the higher the water rises. As your income goes up, the bucket fills up more and more, but it's not like the water somehow levitates and is all held up at that higher level. It's filled up from the bottom to the top. And that's more of really the way that taxes work. Your first bits of income are taxed at a certain rate, and then if you keep making more money, then the next bits of income are taxed at a different rate. And that continues up and up and up at different rates for those different sections of money. Think of it like sections of the bucket, like I've drawn here. So for 2023, the first tax bracket goes all the way up to $22,000. And that first chunk of money will get taxed at 10%. Then whenever you make more money than that, only the next chunk of money gets taxed at a higher rate. So for example here now, 2023, the amount between $22,000 and $89,450 gets 12% taken out for taxes. And then that trend continues as the water level, aka income level, rises. So then for example, the next tax bracket is from $89,451 to $190,750. Only that section of water in the bucket gets hit with the 22% tax. Not all of the water. Look at all those lines. There's so much water below that 22% line that isn't affected by that tax bracket. So don't be worried if you're going to suddenly go from making 85 to 90. It's not like you're going to lose money. I think you're starting to see the difference here between the elevator and the bucket. It's not that suddenly all of your income is taxed at this higher rate just because your income crested over the line. Thinking that way from now on will be deemed elevator thinking. We are not elevator thinkers here. We're bucket thinkers. But wait, there's more. It gets even better because we haven't even talked about the standard deduction yet. Now, the standard deduction is one of two ways that you can deduct money out of your taxes. If you have enough things that will take away taxable income, the government lets you do what's called itemizing your deductions, where like you're going to count mileage and you're going to count the room you use for work in your house and all these different things. But for a lot of us, it's simpler and actually better in the long run to just use the standard deduction. So for a couple that's married filing jointly, the standard deduction for now is $27,700. That's for 2023. So let's see the standard deduction in action. If you make $65,000 as a family, that first big lump of income isn't taxed at all. $27,700 is yours free and clear. Thank you, standard deduction, put it in your pocket. The next $37,300 that's left over is called taxable income. That's going to get some taxing. So of that chunk that you have left, the first $22,000 will get hit for 10% taxes. Not too bad. It's a pretty low tax rate. Then you're left with $15,300 on the top, which falls into the next range there in the bucket. So just what's there in that range, just that 15 grand, gets hit with 12% taxes. So even though at first that 65K seems scary because you were thinking elevator style, elevator logic, thinking it would get a big 12% chunk bitten out of all of it, that's really not the case. Only that last 15K got hit for the 12% tax rate. Okay, enough with buckets and elevators. Let's quickly review all the changes for the coming year in 30 seconds and then get into what it means for us and our money tactically. Because inflation has been so high, the government jumped up the tax brackets to accommodate for that. So you can see in this chart the difference between 2022 and 2023. And in all of them, you can see that the change was 7%, which is kind of close to what inflation was. So the standard deduction went up 7% from 25.9 to 27.7, and then every section of the bucket also bumped up. So what before was the top of the lowest tax bracket was barely over 20,000, now it's 22. The next one, the top was 83, now it's 89, and so on and so forth, all the way up to the top tax bracket, that 37% one, which is over 693,000 and change. Hey, if you're making that much money, you can hire a great accountant and you can figure out how to save some money on taxes. But for the rest of us, we need to talk about what this actually means for our life. Note that the tax rates haven't changed. So that 0%, 10%, 12%, all of that, those numbers haven't changed. It's just the income ranges that all got bumped up 7% from last year. And that's where it ties in with my idea that if you got less than a 7% raise, you'll possibly save money on taxes this year. So let's talk about what this means for us and how that affects us if we did get some amount of raise. In 2021, the average raise percentage was just 3%. That's been the norm. I mean, that's been about the inflation rate, and so that's been something that a lot of companies have gotten used to giving, somewhere between 2 and 4%. The annual mean wage for a full-time worker in 2021 was $53,490 per year, which works out to $1,028 per week. Then in 2022, projections are such that median salary increases will remain at 3%. So it's not really anything changed from the last 10 years. The problem with that for you and me as far as living our life is that inflation has been way worse this year than 3%. And so companies are going to be able to operate more normally this year, which hopefully means they'll have more profit to go around and thus can afford higher raises next year. So initially doing research, I was hopeful that like, hey, we've got profits again, we've got people out in the world again, we're doing things kind of normally. Maybe that means in 2022 and 2023, we can expect bigger raises. So far, based on the reading I've done, it looks like there is some hope for 2023 because some projections are showing expected raises in the 5 to 7% range for at least about a quarter of all employers. So it's not like this is anything guaranteed for us, but around 25% of employers giving a 5 to 7% raise, that could be pretty nice. I think overall the tax bracket change isn't going to revolutionize your taxes or money, like it's not going to make or break anybody, but it's really important to understand so that you don't do something ridiculous like refuse a raise. Please don't do that. The best way to keep your standard of living the same, despite huge amounts of inflation, is to increase your income. It's easier said than done, right? We'll just talk about it. Boom, more income. It's a popular topic right now to increase your income in your spare time, especially if you can get the ball rolling and do it passively. But there's a tricky 3-part trade-off, like a 3-legged stool where if you remove one, you've only got the other 2 left. You need to understand that trade-off before diving into the passive income world. And that's why I made this video. It's probably the best video I've made all year. I'm really happy with how it turned out, and you have to watch it next to get started with passive income the right way. The secret comment, of course, is elevator. See you guys later.